Hi, I'm Peter Rose, founder of Longwood Currency Trading. The dangers of confusing a Forex price swing with that of a reversal. You can get in a lot of trouble, and if you don't understand this difference, you need to pay attention because it could drastically affect your profits from your trading. So we all know what a swing trade is, right? You're looking for the point where, let's say you have a falling price and it's gone down precipitously over a long period of time, and all of a sudden it starts to go up, and it continues to go up for a long way. In other words, the price is swung around from going down to going up. That last lower point is called a swing point because the price is swinging around that point. The danger of doing that, particularly if your price is moving downward, is catching that swing point is like the trading folklore says it's like catching a falling knife. You're trying to catch that in time at its lowest point so that you can maximize on the profit as it goes up. The problem, obviously, is that what if it doesn't reverse and create a longer term trend in the opposite direction? What if it's a simple retracement? I get caught with this an awful lot of the time. I'm not a trend follower because I'm a day trader, but I do respect the trend bias of whatever time frame I feel like picking for that day, which depends on the volatility of the 5-minute time frame that I'm trading. I may go to on a less volatile day, I may go only up to the 15-minute chart to find out what the trend bias is. I may go up to the 1 hour. On more volatile moves, I may want to see what the 4 hour, even the daily is doing. And even go out to the weekly. That sounds very obtuse, but it's all based on your experiences. So what's going on currently, and what does that have to do with what's happened in the past? It's not that anything that happened in the past has to do with what's happening right now. It's a probabilistic analysis that you're undertaking, whether that's for entry analysis or whether you're in some sort of position management. You're not really, in this example of the price going down, you're not really in the movement as it's going down, and then as it starts to swing around, you go, oh, this is a swing, and I'm gonna get out here, or I'm gonna buy, because you can never probabilistically identify a potential swing point. You can't. You can react to whatever your pain threshold is on them. So if you're projecting that price is going to continue to go down and it turns around and it goes up against you, that's either a very minor intermediate movement. It could do that for 3 bars on a 5-minute chart with an ATR of 5. So it could go up 10, 15 points. It could be a real retracement where you're going to go up 30 or 40 pips and then continue on down. Or it could really be a swing. The problem is you can't define the swing until after the fact. In my way of thinking, whatever the daily ATR is, if I get 3 of those ATRs of price movement, then I'm probably looking at a reversal of the direction. I'm probably looking that I'm well into a swing. And that's okay. You could say, well, you've missed, if you've got a daily ATR of 100 pips, you've missed 300 or 400 pips of that move trying to figure out whether it's a swing or not. No, I haven't. Because if it's a swing, then that move will continue 4, 5, 6, 800, 1,000 pips. I just have to change the direction of my bias from down to up. But I can't do that until after the fact. So the problem becomes I'm in the trade and it turns around and it goes up. how much of that reversal am I going to withstand? If I misinterpret that turn as a swing when really it's a retracement, I'm in a lot of trouble, because I'm going to just hold that short for way longer than I should. And that only constantly reinforces your bias to, in this case, the short biased position. Oh, well, I've been sitting here for 2 hours and I've been trading this thing constantly for the last hour or so of that, and I'm making money. I'm taking pieces of it off. I've got this other move. I'm back in it. I've entered another 3 or 4 lots or 2 lots or whatever. It's done a reversal. I've staged in a couple as it's continued to come back against me. Now it's swung around and it's gone back up, and I'm married to that position. I'm going to have a hard time cutting loose of that by saying, oh, well, it's gone 20 pips against me, and so I'm going to exit that trade. That's particularly the case when the price is spiked down on that 5-minute chart, maybe 20 bars of 5 pips, 100 pips, 200 pips. It's just gone shoo. And then you say, well, obviously there's a lot of weight there. I should be getting it again, or I should have held from up here. I mean, those are experienced decisions that you make in real time. You can't be taught that. It has to be a progression of thought through a learning process that takes this particular section of the position management and carves it out and says, okay, let's talk about the specifics of this particular movement, so you can look for other movements that have characteristics like this, and you need to beware of it. The analogy that I always give for these situations is a skier. The advice to all beginner skiers is don't take the last run of the day. And the question is, well, how do you know when the last run is? And it's like, well, I'm just going to make one more run, then I'm going to go in the lodge and have a beer, or I'm going to go have lunch, or I'm going to, it's 4 o'clock and I should be heading for home. That's the last run of the day. You don't want to take that because you're not focusing on your craft, the skiing. And there's more people that get injured, some of them quite seriously, on the last run of the day. And this is true in trading, and why so many say try to do all your trading in one position. If you need to do 2, that's probably okay, but don't go for the third one. Yes, the third one may work out for you, but more often than not, it doesn't. And the reason it doesn't is because you've formed into this trend bias, or price action trending bias, and you take that third trade fully expecting that it is going to continue, in this case, down, and when it flips around and it goes the other way, oh, it's just going to be a retracement. Oh, because it's come down so far, it's come down 100 pips, then it may go up 25 or 30 pips as a retracement before it continues on down. I'm thinking it continues on down. So now it goes to 40 or 50 pips. Now I'm underwater a little bit, and I'm going, well, it can't possibly go any higher because of this support level and this, if you're in the fibs, and all the other crap that goes with it. It'll come back. And pretty soon you're 200 or 300 pips underwater, and you're going to go, oh, shit, I got caught in a swing. Now, there are short-term swings, and there are major directional bias swings that create new trends. How do you differentiate between the two swings? I guess the thrust of my discussion here is I don't believe in swing trading as a viable pursuit for a trader to have, even an experienced trader. There are too many variables and too many questions that you have to ask yourself during the period when that thing is happening. And so I'm going to stick to my guns and say, if you're in an entry situation and the price goes 10 pips against you, get out. It doesn't matter whether it's a swing or it's a minor retracement. It doesn't matter. Just get out and save yourself that money. I was in a trade recently, which I'm still in now, and I'm hundreds of pips underwater on a pretty large position. And the reason for that is that I negated that rule and said, oh, this is a retracement. Prices come down so much and so fast, this thing is going to have to go back up, 30 or 40%. And I sat there and waited, and then it spiked 100 pips against me, and I thought, boy, I'm just going to have to sit here and wait with this for a long time. So 400 pips later, I'm still waiting. So that's the situation that you can get caught in, even when you're experienced, if you don't follow those rules. When you try to say, oh, well, this time it appears. No, you can't have a this time it appears rule, right? And experience is going to get in your way in that instance of decision making. If you're a short-term day trader and it goes against your stop criteria, get out. Don't try to second guess the rule, which has been proven successful over the last 50 trades, and every time you break that rule, you end up losing, or you go underwater so significantly that you feel stupid before the thing turns around and comes in your direction, and then after you pay carry interest and take your 10 pips profit or whatever it is you're going to get, you don't make any money on it. It wasn't worth the sustained losses that you were carrying on an open trade during all this crap. The dangers in misinterpreting a swing from a retracement, or even the magnitude of the retracement, could be catastrophic. Knowing that, you need to have a rule to prevent yourself from doing that. Now, even though I get caught in it, it's when I break the rule that I've defined for myself as to why I should continue to get out at that particular kind of stop. And that has to do with my position management. So even though I'm in an entry stage of that trade, I go immediately to some stuff that I have in my position management toolbox and evaluate that position, and sometimes I'll do something different rather than just sitting there and trying to guess how far it's going to go against me. So be very careful first about adapting the thought that you're going to be a swing trader, because you're not. You can trade after the fact, after the swing has manifested itself to a safe enough degree, and my position is whatever the daily ATR is, 3 times that, that's a pretty good indication that you're in a major swing and not a retracement. Even if prices come down 500 pips, to have that thing swing and go up 200 is not necessarily a swing. Just be very cognizant that, from my standpoint, let me say, not for you to be cognizant, but a reminder to me as a trader to be cognizant of the fact that I cannot even bring into consideration the possibility that I'm going to trade a swing point, that my trade is either going to go against me for an undetermined amount of time, or it's only going to go against me a little bit and then it's going to continue on. The decision as to how deep I want to put that stop is based on your experience. And if I'm working with somebody, my initial work with them is an 8-pip stop. Well, I mean, on a 5-minute chart with an ATR of 5 pips, that's the stop. But even if I was working with someone who doesn't want to trade on the 5-minute, they want to trade on the hourly or the 4-hour, what are you going to do? You're going to set your stop at 1 ATR on the daily. Daily might have a 80 to 120 pip ATR. So you're going to set your stop at 100 pips? Looks like if you're trading one full lot, 100 pips, that's $1,000 on a one lot. So you better think long and hard about what you're hearing about how these folks are constructing these rules and this ridiculous stuff about risk to reward, and how to determine how much risk to take based on the reward that you're looking for, which is different than the risk to reward analysis. Risk to reward is a rule, and the risk as a function of the reward is an analysis, which is different. Your awareness of the danger of trying to bring a swing trade scenario into play is far greater than just taking the hit and getting out and taking another run at the position, and even at the risk of losing it 3 times, because I guarantee you, whatever loss that you sustain by taking that wrong trade 3 times, how much ever that is, 10 pips or 20 pips at a pop, is minuscule in comparison to the one time where you get it wrong. It runs 400 or 500 pips against you, and you're still sitting there going, man, I don't know how this happened. Why was I so stupid? Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.